See, now this same exercise which we have done, if we are, here we have taken the total risk on the x-axis and the return on the y-axis. Now a small improvement on the top of that coming out, the total risk of any security, you are splitting it into two parts. The total risk on a security, we are splitting it into two parts, calling it as systematic risk and unsystematic. What is this bringing out? See, if I am saying the total risk is around 12%, in this case, the total risk is around 12% for risky security. The market portfolio is having a total risk of around 12%. Now, what we are saying is, out of this total risk, some portion of it could be because of the market itself, or which is inherent in the system itself, because of the equity securities. See, this is not a risk-free security. It's an overall equity securities. If I am looking at, this is the particular amount of risk that is inherent in it. So that particular risk is what we are calling as a systematic risk. So basically it's like, see, if at all I want, here we are talking of a complete portfolio. I mean, market portfolio is what we are talking of here. But now look at one individual security. Now we'll take it to a slightly different level, which is at a one individual security level or one small portfolio level, not the market portfolio level, one individual security or one small portfolio. In that total risk of that security, what we can very well say, some portion of it is already inherent as a part of the market. Whereas there could be some portion of the risk which is purely specific to that security, probably because of management or probably because of the company business or whatever it is. There could be some amount of risk. Again, when I am using risk, it's nothing but the fluctuation in the stock price of that particular company. If I am talking of a stock, this is specific, correct. This is more like a general risk. This part is more general, whereas this part is more specific to a company. Every company, so as a part of the equity market, this much risk will definitely be there, whereas this part is more and more specific. Now, what the portfolio management also says is, you cannot remove this risk. Whatever is the portfolio, whatever is the combination of the securities you are combining, you cannot remove that part of the risk. Only this part can be diversifiable. This risk you can completely remove by creating appropriate portfolio. So this part of the risk you cannot remove at all. And every security will have a different level of correlation with that entire market, right? Every security will have a different level of correlation with the entire market, because see, entire market, if I am saying this is the one which is the entire market, right? This is the one which is the entire market. Now I am not talking about a risk-free security with it. I am talking about some single, probably Infosys security right now. That particular Infosys security will have a different correlation with respect to this one, which is the market portfolio. I am trying to find out what is the relationship between those two. That portion of it is what we are calling as a systematic risk. Based on the correlation, if they are very heavily correlated, right? If they are very heavily correlated, then the systematic risk will be more or less in line with that of the market portfolio. Less correlated may not be in line with that of the market portfolio. And that measure of the systematic risk of every company is what is being called as beta. The measure of the systematic risk of the company is called as beta. And what any typical portfolio management process will target is remove this diversifiable risk. Because see, if we look at the example which we have taken earlier, I have combined two securities, right? I have combined two securities, and because of that two securities, probably I have got a risk of 12% and return of 11.8%. Now I add one more risky security to it. It may become 11%. I may add one more risky security to it. It may become 10.8%, 10.5%, 10%, but it cannot come down below a certain percentage, because that's the amount of risk that is inherent with the equity markets itself. So that is what is the proportion which we are calling as a systematic risk, and for this particular security, we are simply saying beta is a measure of the systematic risk for that security. The way it is computed in any case is the covariance between the security returns and the market returns. How the relationship between the security and the what we called as a market portfolio. What is the kind of a covariance that is existing between them as a proportion of the variance of the market portfolio. So market could be index, market could be the best optimal portfolio. Look at market, always we have defined even in the earlier case as a market portfolio is something which is preferred by large set of investors. That's the word we have used for it. So it's primarily, when I look at, let's say, index, generally index is what is used as a substitute for market portfolio. Either a Sensex or a Nifty kind of stuff is being used as a alias for the market portfolio. So using this, for every security, I can find out the beta of the security, right? So what is also found out is even the same CML line. Now if I draw by taking the betas on the x-axis, by taking the betas of the securities on the x-axis and the returns on the y-axis, here also you will get a similar kind of a line. Here also we will get a similar kind of a line where probably this is the risk-free rate of return. And okay, here let's see, this is zero risk. And if the risk is 1, if the beta is 1, what will happen? Beta is 1 means covariance of the security to the market is equal to the variance of the market, right? Which means the return also is same as that of the market. So if at all the beta is 1, the return should be the market return itself, which is nothing but, because two securities with the same level of risk should have the same level of return. So when I am saying the market, if a security is having a same risk as that of the market, then obviously the return also should be the same as the market. So what we are saying is, if the beta of the security is 1, the return associated with it should be equal to the market return itself. Now try to find out the slope of this particular line. The slope of this particular line is difference of the y-axis, Rm minus Rf, by the difference of x-axis, which is 1, which is nothing but the slope of this line is the market premium. Correct? Now I'll extend this a little bit more. I'll assume some other company, some other security whose beta is some beta, whose systematic risk is some beta. Now if this is the systematic risk, then obviously it should give me this much of return. This should give me this much of return. Now based on this, I can find out what is the slope. Now the slope for me is Ri minus Rf divided by beta. Ri minus Rf divided by beta minus 0, which is beta. This is the slope. Now this slope, the other name for it is called as a trainer ratio. This is called as a trainer ratio, which means this is the same line. Just with taking beta equal to 1, I have created one formula for the slope. By taking beta equal to some beta, I have taken some other formula for the slope, which means there are two definitions of the slope for this particular line. One definition is market premium. So the slope of this particular line, where you take beta on the x-axis and the return on the y-axis, the slope of this particular line is market premium, which is also equal to the trainer ratio also. And now, because the slope of these two are equal, these two should be equal. Now, if I equate these two, what you see is Ri minus Rf by beta is equal to Rm minus Rf. So, just a small rearrangement is saying Ri minus Rf equal to beta times Rm minus Rf. And from here it comes out that Ri equal to Rf plus beta times Rm minus Rf. A very classical equation called as capital asset pricing model, CAPM equation. So which is also saying that the return on any security is equal to the risk-free rate of return plus beta is nothing but a measure of systematic risk. So that systematic risk times whatever is the market premium. This particular equation is called as a CAPM equation, which is used in lot of valuation applications, equity valuations kind of applications, and it has a lot of applications across the investment space to find out risk adjusted kind of a return. Wherever I want to find out the risk adjusted return, because this is taking the risk into consideration, and based on the risk it is trying to map with the appropriate return. So that is where we are calling it as a risk adjusted return. So this formula, if we are remembering, we can actually calculate what should be the expected return on this particular security if I know the beta of this security, systematic risk, because the assumption is the whole of unsystematic risk or whole of the company specific risk is completely diversified away through the creation of a portfolio. So in deriving this equation, there are so many assumptions that are typically made, right? If these assumptions are not there, what will happen? We have one more chapter to deal with it. But in dealing with it, these are the various assumptions that are made. No transaction costs involved, right? These are all like away from realities. Assets are infinitely divisible. Probably I can buy 0.01 share also, right? Whereas in reality, we cannot buy 0.01 share. But this is going with a mechanism that assets are infinitely divisible, no taxes. So which means no, I mean, even if I get something in the form of a dividend or a capital gain, it hardly matters. Then investors are price takers only. They are not price setters. They cannot decide the price. In reality, probably if I buy a large volume of share, obviously I can decide on the price. But it is making an assumption that investors are price takers only. Market is very much efficient that the prices will get automatically adjusted. And investors are purely making their investments based on the portfolio return and risk, which means everyone is knowledgeable about the concepts of beta, everyone is knowledgeable about risk return, and only looking at those calculations only everyone will invest, which may be away from reality because there will be a lot of irrational investors present in the system, right? So all are away from the reality. Unlimited short selling is allowed. we have already discussed it may not be possible in the real world, because if at all the security price is falling drastically, it's very difficult to get into an unlimited short selling procedure, because there will be generally also exchanges put this kind of rule saying uptick rule. Only when the price is moving up, then only you can think of doing a short selling on the security. If it is moving down, obviously no one is ready to give the security to you unlimited quantities, because they can very well do the shorting on that. So unlimited shorting is very much not possible. Even borrowing and lending, it is assuming that it can happen at the risk-free rate. We have seen that low risk takers generally get into a lending part, and high risk takers get into a borrowing part. Now, if in reality, it is not possible to borrow unlimited. Let's say I want a 15% return in the earlier example. I had to borrow 50% more money. Now, if I am borrowing 10% more, 20% more, probably I may get it at a normal interest rate. But if I have to borrow 100% more, double to my money, obviously I would be treated as a risky borrower, and my interest rates will typically go up, which means unlimited borrowing cannot happen at the risk-free rate. Probably if I am more generous enough, I can lend unlimited at risk-free rate. But obviously borrowing is not in my hand. So unlimited borrowing does not happen at a risk-free rate. So that is where, but this is making an assumption that unlimited borrowing and lending are happening at the risk-free rate. Investors always have the same time horizon, all of them. But in reality, there could be very short-term investors, there could be very long-term investors. So you cannot generalize on the term period of investment of the investors and homogeneous expectations. Everyone is having the similar expectation, just like of a market portfolio, right? Which may or may not be the case again. So because of taking all these things, they have derived that particular equation by concept. Of course, even if I remove some of these assumptions, that equation is not violated to a large extent. We'll see that in our other chapter, where the non-standard form of CAPM is being studied. But in the standardized form, we are saying that we are going ahead with these kind of assumptions, and based on these assumptions, that particular equation of Ri equal to Rf plus beta times Rm minus Rf is being derived. Now, okay, this we have already talked about. Yeah, so once the SML is, once the CAPM line, this is the CAPM line we are talking of, means if a company is having this much of beta, it should give this much of return, right? But if it is giving this much of return, right, in reality, now I'll compare, it should give this much of return. If a company is having this much beta, it should give this much return. But in reality, it may have given this much of return. Very much possible. So these kind of companies, we call them as undervalued companies. Means their risk is lesser compared to the return which they are giving. Because if they have given this much of return, obviously their beta should have been somewhere here. But their beta is only this much, which means their risk is much lesser compared to what kind of return they are generating. Or probably they are giving more return than what they are supposed to give. Because for this level of a beta for a company, this is the expected return. But in reality, they are giving this much of return. So they are performing more above the expectations. And that is why we call these as undervalued companies. And as a part of the investor analyst recommendation, these kind of securities come for a buy recommendation. Whichever are above the CAPM line, otherwise there is another name for the CAPM line called as a security market line, SML. The same CAPM equation line, the equation is called as a CAPM equation. This line is called as a security market line because this beta is not for the whole market, it's for one single security or one single small portfolio. So this is why we call it as a security market line, SML. So what we are simply saying is, if any company is actually giving a return above the SML, we are calling them as more better performing kind of companies whose which are called as undervalued, and as analyst recommendation they go as buy recommendation. Whereas those securities which are below the SML, they are called as the overvalued kind of companies because they are giving much lesser return than what they are expected to give. So that is where we call them as overvalued securities, and the analyst will give a recommendation of sell on these securities. Now what will happen? If a sell happens here, the price of it will actually come down, right? The price of it will actually come down. If the price is coming down, right? If the price is coming down, obviously now if someone is buying, it is available at a cheaper rate. If now someone is buying, the return which he is going to get is higher. See, if the price of it has already fallen, lot of sale has happened, the price of it has already fallen, now it is available at a much cheaper price. If I am expecting 100 after 1 year, now I am buying it at a cheaper price. So obviously the return that I am going to get is actually going up. So what will happen is, because of this buying and selling process, in the long run, a security which is here slowly will move up here. A security which is here, because of heavy buying, the price going up drastically, the return what we will see is it will again come back to the SML itself. So in the long run, we see that all the securities will lie on the SML curve itself, SML line itself. Whereas during the short run, some of them could be above the SML, some of them could be below the SML, and wherever that above below kind of scenario is there, that will prompt for a buy sell decisions from the analysts, right?